Hello, how are you? Welcome to Tahad Tech. Today is our topic is risk purchasing group. Like risk retention group, purchasing group must be made up for per person or entities with like exposures and in a common business. However, whereas RRGS are liability insurance companies owned by their members. Purchasing groups purchase liability coverage for their members from admitted insurer, surplus lines carriers or RRGS. Laws in some states prohibit insurer for giving group form to purchase insurance advantages over individual. However, purchasing groups are not subject to so-called fictitious group laws, which requires a group to have been in existence for a certain period of time or require a group to have a certain minimum number of members. The Risk Retention Act of 1986 specifically provided for purchasing group to be created to purchase liability insurance for member for the sponsoring group. Catastrophe bonds and other alternative risk transfer product. A number of alternative risk transfer products such as insurance linked securities and weather derivatives have developed to meet the financial risk transfer need of business. One such product, catastrophe bonds, risk based securities sold via the capital markets, developed in the wake of Hurricanes Andrew and Elenki in 1992 and the Northridge earthquake in 1994 mega catastrophe and that resulted in a global shortage of insurance for insurers for such disaster. Tapping into the capital market allowed insurer to diversify their risk and expand the amount of insurance available in catastrophe prone area. Zurich Financial Company was the first major catastrophe bonds to be tracked. The $190 million bonds was tracked by 2005 Hurricane Katrina and resulted in a total loss of principal. Catastrophe bonds are now multi-billion dollar industry. Catastrophe insurance issue. The term of catastrophe in the property insurance industry denote a natural or man-made disaster that is unusually severe. An event is designated a catastrophe by in the industry when claims are expected to reach a certain dollar threshold currently set as $25 million and more than a certain number of policyholders and insurance companies are affected. The magnitude of the damage caused by Katrina and the potential damage Hurricane Rita might have caused had it not weakened from an intense Category 5 hurricane has tracked re-examinations not just among insurers and reinsurers but also among public policy and political leaders of how the United States deal with the financial consequences of such massive property damage and personal loss. Disaster losses along the coast are likely to escalate in the coming years in part because of huge increase in development. One catastrophe modeling company predicts that catastrophe losses will double every decade or so due to growing residential and commercial density and more expensive building. Data from the Census Bureau collected by USA Today show that in 2016, 34.9 million people were seriously threatened by Atlantic hurricanes compared with ranked as the single most US natural disaster. Man-made catastrophes such as the attack on the World Trade center can also cause huge losses. The attack led Congress to pass the Terrorism Risk Insurer Act in November 2002. Since the TRIA has the authorized twice, the last authorization passed at the end of 2007 extend the law to 2014. TRIA provides a federal backstop for commercial insurance losses from the terror acts, making it easier for insurers to calculate their maximum loss for such a catastrophe and thus to underwrite the coverage. See the topic on terrorism risk and insurance. Thank you for watching my video. If you like my video, please press the bell icon for future video update and also subscribe my channel. Thank you.